Imagine waking up tomorrow, grabbing your phone, and seeing XRP trading at $2,500. Your first thought, no way. That's got to be a glitch. But what if it wasn't? What if that number staring back at you was real? Well, that's exactly the rabbit hole we're diving into today. Because somewhere between hype, hard math, and market mechanics, a top crypto CEO actually made that prediction. Welcome back to Bullion IQ, where we cut through the noise and talk facts, logic, and strategy, not fairy tales. I'm your host, and if you're new here, make sure to hit subscribe because we decode the crypto chaos so you can think smarter, not just dream bigger. Now, let's be real for a second. XRP at $2,500 sounds absolutely insane when it's barely hovering around $3 right now. That's an 83,000% price increase. Numbers that make even die-hard XRP holders raise an eyebrow, but here's the twist. There's an entire theory behind it, one that doesn't rely on wishful thinking or magic moonshots. It's rooted in one of the oldest principles of economics: supply and demand. This all started when a well-known figure in the crypto world, Jake Claver, CEO of Digital Ascension Group, dropped a bold claim. He didn't just say XRP could rise, he said it could explode, potentially reaching $2,500 per coin. And instead of rolling his eyes at the usual to-the-moon crowd, he laid out a surprisingly structured argument that makes you pause and think, could there be more to this? Now, before we get swept away in big numbers and wild speculation, let's pull back the curtain and see what's really going on here. Because to understand why some analysts are even entertaining this number, we've got to first tackle one massive misconception: market cap. Most people hear XRP at $2,500 and immediately scream impossible. That would make XRP worth $150 trillion. And they're right, at least on paper. That's more than the entire global stock market combined. But the key phrase here is on paper. Market cap isn't real money sitting somewhere in a vault. It's a formula. Price times circulating supply, and it can easily give a distorted picture of what something is truly worth or how liquid it is. Think of it like this. If tomorrow only one XRP traded hands for $2,500, the market cap would instantly look like hundreds of trillions. But could anyone else actually buy or sell at that price? Probably not. Because what really matters isn't the theoretical value. It's how much XRP is actually available for sale and how many people are trying to buy it at that exact moment. That's what drives price movements. And that's where Jake Claver's idea gets interesting. He doesn't believe XRP will suddenly shoot up because of hype or manipulation. He believes it could happen due to a supply shock, a situation where demand stays the same or rises, but available supply gets drastically reduced. Now, here's something unique about XRP that most people overlook. Its total supply is fixed. There's no mining, no inflation, no printing new tokens out of thin air. All 100 billion XRP that will ever exist were created back in 2012. That's it. No more can ever be minted. And a portion of that supply is permanently locked in what's known as a black hole account, inaccessible forever. In other words, XRP is not just limited, it's shrinking. Every single transaction burns a tiny amount of XRP, permanently removing it from circulation over time. That means less supply and higher scarcity. So, when you combine fixed supply, deflationary mechanics, and the potential for a sudden spike in demand, you've got a recipe for extreme price pressure. But here's the million-dollar question. What kind of global events could actually trigger such a supply shock and drive XRP into the thousands? Well, that's exactly what we're going to break down next, because Claver didn't just pull this number from thin air. He listed out specific real-world dominoes that would need to fall, and trust me, some of them are shocking. Now, let's go a little deeper into what's actually driving these massive moves in XRP and the overall crypto sentiment. People often think crypto just moves on hype or rumors, but the truth is that institutional behavior plays a much bigger role than most realize, and when you see sudden spikes, it's rarely just random. Its accumulation and distribution cycles quietly controlled by large holders are what we call smart money. These institutions move silently when the market is asleep, and by the time the public reacts, they're already in profit. That's exactly why retail investors always end up chasing instead of leading. But if you've been following the signs lately, you'd notice that the XRP charts have been forming a structure that doesn't reflect a panic market. Instead, it's a controlled squeeze, a buildup that hints at something brewing behind the scenes. Maybe something even the mainstream media hasn't caught on to yet. When big money starts flowing into assets like XRP, it's never random. There's usually a deeper connection. Regulatory signals, liquidity corridor tests, or hidden partnerships that get quietly filed before becoming public news. If you check the recent on-chain data, you'll see unusual wallet activities from exchanges and known institutional addresses, transfers that don't make sense for day traders but do for settlement testing. These are the moments when seasoned analysts start paying attention. The irony is that the average investor still waits for confirmation from YouTubers or influencers before making a move. But the ones who study market structure know that by the time confirmation comes, the real opportunity is already gone. That's why being early and understanding fundamentals before hype kicks in is everything. Now imagine what happens when regulation shifts just slightly in favor of crypto. We've seen hints from the SEC softening its tone to global finance ministers discussing digital assets in G20 sessions. When central banks and governments stop treating crypto as a threat and start viewing it as a bridge to liquidity efficiency, everything changes, and XRP sits right at that intersection. This isn't about speculation anymore. It's about utility. If a currency can move billions across borders within seconds at a fraction of a cent, then it's not just another token, it's infrastructure. And infrastructure-level adoption isn't hype-driven, it's purpose-driven. The smart ones know this. And that's why, despite all the noise and FUD, they're still quietly accumulating. But let's pause and think emotionally for a second. What if this really is that rare window? That moment we look back on in a year and say, I should have seen it coming. Every crypto bull run in history starts with disbelief. People mock it, call it manipulation, label it a scam until the same people start buying at 10 times the price they laughed at. That's human psychology. Fear of being early keeps most people broke, while the few who are willing to look deeper end up ahead of the crowd. It's not about gambling. It's about understanding the game before others realize it's even being played. And that's exactly the energy right now surrounding XRP. Quiet, tense, but full of potential energy ready to burst. So, as we continue breaking this down, remember, price is only a reflection of perception. The real story is always in the movement before the headlines. Right now, there's movement, silent, powerful, and unmistakably intentional. The question isn't whether XRP will rise, it's whether you'll recognize the moment before it happens. And if you've been following this channel, you already know that timing, patience, and awareness are your greatest tools in this unpredictable market. Now that we've covered the first few dominoes that could influence XRP, let's move on to the next set of triggers because this is where things start to get really interesting. One of the theories that Jake Claver and other crypto analysts often discuss is related to liquidity, specifically the idea that exchanges may not always have enough XRP available for sale to meet sudden surges in demand. This is sometimes referred to as the supply crunch or the Shane Ellis theory. Imagine a scenario where a large buyer enters the market with the intention to purchase a significant amount of XRP. If the order books are thin, meaning there aren't many sell orders at each price level, that single large buy could rapidly push prices higher and higher. Every new buy consumes the available XRP for sale, leaving fewer coins for the next buyer. In extreme situations, this could create a short-term price spike that seems almost impossible, but is entirely based on supply-demand mechanics. Another advantage XRP has, and a major part of Claver's argument, is its ability to settle transactions 24/7, any day, any time. Traditional financial systems, banks, and stock exchanges shut down for weekends and holidays, but crypto never sleeps. This is crucial in times of market instability or crisis. Imagine a scenario where traditional markets freeze while a financial emergency occurs on a weekend or during off hours. Institutions may need to move money quickly, rebalance portfolios, or manage liquidity issues. XRP can handle those transfers instantly, making it a practical solution when speed is critical. This kind of utility could suddenly make XRP a preferred asset for institutions during unexpected events, pushing demand even higher. Then there's the so-called Project Ion developed by the DTCC in collaboration with R3. This initiative is designed to modernize the settlement of U.S. stock trades, essentially acting as a bridge between different ledgers. Claver points out that an asset like XRP designed to move value quickly and securely could be a perfect fit for such a system if Project ION or similar infrastructure projects decide to use XRP as a liquidity bridge. Even partially, it could dramatically increase institutional demand. Unlike speculative pumps, this would be demand driven by real-world utility and adoption. Institutions would not just be buying to gamble. They would be buying because XRP becomes a tool for operational efficiency. Claver also highlights geopolitical events and macroeconomic instability as potential accelerators for XRP's growth. Rising oil prices, regional conflicts, or global economic uncertainty often cause investors to look for alternative assets. If traditional investments start underperforming or appear risky, money tends to flow into safe haven assets. XRP's fast settlement capabilities and growing regulatory clarity make it a candidate for such capital inflows. Investors looking for efficiency and security during turbulent times could view XRP as a more practical alternative to other cryptocurrencies or even traditional assets. In this sense, crises don't just create fear, they create opportunity for assets with strong utility. While all these factors, supply crunches, 247 transactions, Project ION, and global instability sound promising, Claver is quick to remind everyone that nothing is guaranteed. Price predictions like $2,500 per XRP are based on a perfect storm scenario. Each domino would have to fall in a specific way, and timing matters greatly. Even if one factor aligns perfectly, if others do not, the market may respond differently. That's why being realistic is as important as being optimistic. In crypto, the combination of high reward and high risk is unavoidable, and anyone chasing astronomical returns must understand both sides of the equation. At the same time, the narrative is exciting because it reminds us that crypto markets are not purely random. They respond to global financial patterns, institutional behavior, and technological adoption in measurable ways. The fact that XRP's supply is fixed and slowly decreasing due to the burn mechanism adds a layer of scarcity that traditional assets rarely possess. Combine that with a sudden surge in demand, whether from institutions, crises, or adoption-driven inflows, and you have a scenario where rapid price increases are technically possible, even if unlikely in the short term. Understanding this context is key for any investor who wants to separate hype from plausible opportunity. Finally, it's important to keep perspective. The world of crypto is full of extreme stories, and while XRP has unique characteristics, the numbers like $2,500 are not to be taken lightly. They represent a theoretical extreme under very specific conditions. And the more valuable takeaway is understanding how these triggers interact, why supply and demand matter more than total market cap, and how real-world adoption could slowly transform XRP from a niche cryptocurrency into an institutional tool. It's this combination of theory, real utility, and potential market behavior that makes following XRP so compelling. Continuing from where we left off, let's explore some of the remaining scenarios that Claver believes could push XRP to extreme levels and why these factors are more interconnected than most people realize. One major idea he discusses is a broader financial shock, something that could ripple through both traditional markets and crypto simultaneously. Think of it as a sudden reversal of confidence across major economies. Investors might start liquidating assets rapidly, and as liquidity dries up, people look for alternatives that are fast, secure, and accessible at any moment. This is where XRP's infrastructure really shines. Unlike slower centralized systems, it can move massive amounts of value within seconds, making it an attractive option when everything else seems stuck. That kind of speed and reliability can suddenly turn XRP from a speculative coin into a lifeline asset for institutions and high-net-worth investors. Another scenario Claver highlights is regulatory clarity around XRP. For years, XRP has faced scrutiny, and while that created uncertainty, it also positioned it uniquely compared to other cryptocurrencies. Many projects operate in a legal gray zone, which makes investors cautious. XRP, on the other hand, has been in ongoing discussions with regulators and has steadily clarified its legal status. In a market full of uncertainty, regulatory clarity becomes a premium. Investors tend to favor assets they understand and trust from a compliance perspective. If a large-scale financial or political event shakes confidence in other tokens, XRP could benefit by default. People fleeing risky or unregulated cryptocurrencies may see XRP as a safer harbor, which in turn pushes demand and potentially price. Claver also talks about cascading effects from multiple triggers happening simultaneously. For example, imagine a sudden crisis in the stablecoin sector like Tether losing its dollar peg coinciding with a liquidity crunch in traditional markets. On top of that, global events like rising oil prices or geopolitical tension could force investors to move capital quickly. In such a scenario, institutions that need to transfer funds efficiently would naturally consider XRP. It's not hype, it's operational necessity. When multiple stress points in the global financial system occur at once, the assets that are most flexible and reliable often absorb the inflows. XRP's unique structure, fixed supply, transaction burn, and fast settlement makes it well positioned to capture that interest. This is exactly the type of real-world domino effect Claver envisions as the catalyst for extreme price movements. Now, it's also important to note that Claver doesn't expect these events to unfold neatly or predictably. Markets are messy, and there are countless variables that can change outcomes. Timing matters greatly, and even if the ideal conditions appear, there's no guarantee that XRP will spike immediately or hit the theoretical $2,500 mark. The value in Claver's analysis is not in the exact number, but in understanding the types of events that can influence the market dramatically. For investors and enthusiasts, this is a lesson in watching macroeconomic indicators, regulatory developments, and market liquidity more closely than simply following price charts or social media rumors. Finally, Claver emphasizes that market psychology plays a key role. Fear, uncertainty, and doubt drive mass movements. And in crypto, sentiment often accelerates trends faster than fundamentals alone. When investors start seeing early signs of supply constraints or institutional adoption, panic buying can amplify natural price pressures. Combined with XRP's shrinking supply, even a moderate increase in demand could create significant upward pressure. While $2,500 remains an extreme scenario, the mechanics behind it are grounded in supply-demand economics, adoption potential, and real-world liquidity needs. This perspective transforms the conversation from impossible moonshot to plausible under the right conditions, which is why so many analysts watch XRP closely despite its relatively low current price. Now that we've covered liquidity shocks, regulatory clarity, and cascading financial crisis, let's dive into the remaining key factors that Claver believes could drive XRP's price toward extreme levels and why they matter more than most people realize. One of the most interesting aspects is Project Ion developed by the DTCC in collaboration with R3. This is essentially a modern settlement system for U.S. securities designed to speed up the way trades are recorded and cleared. On the surface, it might not seem directly related to XRP, but here's the connection. Claver believes that Project Ion needs a neutral, reliable digital asset to act as a bridge between different ledgers. XRP was literally built to be that bridge. Its speed, low cost, and ability to settle instantly make it an ideal candidate. If institutions or financial infrastructure projects like Project Ion start using XRP to move value efficiently, it could create a consistent high-volume demand that goes far beyond speculative trading. In other words, adoption driven by utility rather than hype could fundamentally shift XRP's market dynamics. Next comes geopolitical instability, which often works as an indirect but powerful catalyst. Claver points to rising oil prices, tensions in the Middle East, and other global shocks as scenarios that could push investors towards assets that provide speed, efficiency, and reliability. When oil prices spike, inflation rises, central banks may act, and certain debt strategies start to collapse. In such moments, investors often scramble to move money quickly to safer or more liquid assets. Traditional systems like banks and stock exchanges may not be able to respond fast enough. XRP, with its 247 settlement ability, becomes an instant solution. This creates a perfect storm where supply and demand dynamics could push prices upward sharply, especially if other stress points like tether instability or carry trade unwinds are happening at the same time. Another factor Claver emphasizes is XRP's shrinking supply. Unlike most cryptocurrencies that continue to mint or release new coins, XRP's supply is fixed, and a small amount is burned with every transaction. This means that over time, not only is no new XRP being created, but the total supply is gradually decreasing. Combine that with sudden surges in demand from institutions, investors fleeing instability, or new adoption in financial infrastructure, and you create a classic supply crunch. Economics 101 tells us that when supply tightens and demand rises, prices go up, sometimes very quickly. This is exactly what makes Claver's extreme price predictions technically possible, even if they rely on a perfect set of circumstances. Claver also considers market psychology. Investors are influenced not just by fundamentals but by fear of missing out and momentum. If early signs of increased demand or adoption appear, panic buying can amplify price movements. The thin order books on exchanges make these movements even more pronounced. Even a modest increase, buying activity can push prices higher when supply is limited. That's why supply, adoption, and sentiment all interact together. Each amplifies the other. This isn't just theory, it's observable in historical crypto trends where liquidity constraints, adoption, and media attention combine to create sudden, dramatic price spikes. Finally, it's important to remember that while all these factors make the $20,500 scenario theoretically possible, it's extremely unlikely that all will align perfectly. Claver himself admits that this is a high-risk, high-reward scenario. The more realistic outcome is gradual adoption, steady demand growth, and moderate price increases over time. The key takeaway is understanding the mechanics. Why XRP is uniquely positioned to respond to global events, infrastructure projects, and liquidity crises. Following these signals can help investors make informed decisions rather than blindly chasing hype. The combination of scarcity, speed, institutional adoption potential, and regulatory clarity makes XRP a crypto asset that demands attention, even if the extreme price targets remain speculative. Alright, let's wrap everything up and really focus on what all of this means for someone holding or watching XRP. After diving into Claver's scenarios, from supply shocks and shrinking XRP to Project ION, liquidity crisis, and geopolitical instability, the big picture starts to become clear. XRP is not just another cryptocurrency, it's a unique digital asset designed with purpose. Fast settlement, fixed supply, and institutional-ready architecture. That combination is rare in crypto, and it's why analysts like Claver believe that under the right conditions, the price could move dramatically. Now, that doesn't mean $2,500 per coin is a guaranteed outcome. Far from it. The reality is that this level of increase requires multiple global and market events aligning perfectly. But even if the perfect storm never fully materializes, understanding these dynamics gives investors an edge in reading the market. One key takeaway is the importance of supply and demand rather than total market cap. So many casual investors look at market cap comparisons and assume extreme numbers are impossible. But the real driver is liquidity and available supply. If most holders decide to keep their XRP and a wave of demand hits, prices can spike far beyond what conventional logic predicts. It's about understanding how much XRP is actually available in the market at any given moment and how institutions and large holders behave. Tracking on-chain movements, exchange supply, and adoption trends provides a much clearer picture than just looking at headlines or hype cycles. This is the kind of analysis that separates serious crypto enthusiasts from casual observers. Another major insight is the power of adoption-driven demand, Project ION, and other infrastructure. Developments highlight that XRP is not purely a speculative asset. Institutions could use it for real-world liquidity management, cross-border settlements, and financial efficiency. When money flows in because XRP solves practical problems, the market behaves differently than when driven purely by hype. Understanding the distinction between utility-driven adoption and speculation is essential for anyone planning to invest or hold XRP long-term. That's why following these projects and industry news is as important as monitoring price charts. Claver's scenarios also emphasize timing and patience. Even if all triggers eventually align, it might take months or years. The crypto market can be volatile and unpredictable, and there's no guaranteed schedule. Being patient, staying informed, and managing risk are just as important as spotting potential moonshots. This means setting realistic expectations, diversifying your investments, and never relying entirely on extreme predictions. Optimism is valuable, but discipline is even more crucial in volatile markets like crypto. This approach allows you to benefit from opportunities without being blindsided by sudden downturns or hype-driven swings. Finally, the psychological lesson is vital. Human nature reacts strongly to fear of missing out and market mania. Understanding that these emotions drive price movements can help you make more rational decisions. XRP's potential is exciting, but keeping a grounded perspective ensures you don't make impulsive choices based on sensational numbers. The excitement of imagining 2,500 XRP is fine for motivation, but your strategy should always be informed, measured, and realistic. By combining awareness of supply dynamics, adoption potential, macroeconomic events, and psychological behavior, you position yourself to navigate the XRP market intelligently. So, in conclusion, while Claver's $2,500 prediction is extreme and unlikely to happen overnight, it illustrates the forces that could drive dramatic price changes. Supply scarcity, institutional adoption, real-world utility, liquidity constraints, and global crises all interact to create potential for rapid movement. For XRP holders, the practical takeaway is to watch adoption trends, track supply and liquidity, and remain patient while being informed. Optimism paired with grounded strategy is the best approach. Keep learning, stay vigilant, and always approach crypto with both curiosity and caution. And as always, remember that these insights are educational, not financial advice. The real power comes from understanding the market mechanics and making thoughtful decisions rather than chasing headlines or unrealistic hype.